Welcome to the latest in Fitch's series of global virtual investor meetings. We have one-on-one meetings with hundreds of investors each year and want to give you a glimpse inside these meetings. I'm Rui Pereira, and I head up Fitch's North American Structured Finance team here in New York. I'm thrilled to be here today with Hylton Heard, a senior director and lead analyst in our ABS group. Welcome, Hylton.
Thank you.
Hylton, let's start the discussion focused on the state of the consumer. So the macro environment remains quite positive. Unemployment is sub 4%. When you look across the consumer ABS portfolio, what lending trends or asset performance trends give you the most concern?
Rui, I think the overarching theme today is increasing consumer leverage. And that's across several asset classes, really driven by credit cards, student loans, auto debt, and unsecured lending. In terms of student loans and credit cards, we're not too concerned on those sectors. Performance is still within our expectations. Same goes for auto loans. One of the areas we see a lot of aggressive growth and also aggressive underwriting is marketplace lending. This sector's experienced tremendous growth in the past 3 to 5 years. And has got heated competition overall from new entrants coming in. Having said that, we have a rating cap of single A on the sector for several reasons. Firstly, performance though. We're seeing the 16 and 17 vintages having increasing delinquencies and losses really driven by that aggressive underwriting during that period. That's driving losses higher. That's definitely an area of focus that investors should be required scrutiny on. When you combine that with higher debt levels in terms of credit cards, auto loans, and student loans, that's going to contribute to pressure on consumers, mostly in the lower FICO credit buckets, sort of the subprime area. We're definitely focused on that today, and investors should be as well going forward through 2018.
Great. Let's focus on some of the core sectors where we've been quite active. I think the industry as a whole, and that is auto loan and lease. Can you provide an update on the trends, both in terms of underwriting and asset performance that we're seeing coming out of the auto sector, particularly as sales start to slow down?
I think overall the competition here is still heated, but the market actually has pulled back starting in 2016 in terms of lending volume and also in terms of standards. We've seen lenders hold standards steady in the past year and a half in ABS pools in the auto sector, both loan and lease. Lease is more a focus for us today just because of the rising off-lease volumes, which are impacting the used vehicle values overall. In terms of prime auto loan, no concerns there. We have a positive rating outlook for ratings performance and a stable outlook for asset performance. Switching to lease, that's really more of a focus, and really the focus here is on residual performance, which is under pressure. We're seeing rising volumes come from those off-lease values. They've increased this year double digits over last year in terms of percentage returns, and they're going to increase further next year as well. So the used market is pressured there overall. However, we have very conservatively derived residual value proxies, and it would take something substantial to move the needle in terms of ratings performance, which we really don't see in the next year.
Excellent. Let's talk a little bit about one of the emerging asset classes in ABS, aircraft ABS. So this is a sector that's grown significantly in 2018. There's abundant liquidity. There are many new entrants coming into the market. Can you talk a little bit about the development in this market, some of the risks that these new entrants are posing, and how we're accounting for them in our analysis?
Yes, I would say, Rui, this is probably the most heated sector in ABS today. It is a relatively small sector in terms of issuance, but in terms of actual lessors coming into the space and overall competition, it's very heated. Really, that's driven by the robust demand for global air travel. Henceforth, the airlines are doing very well today financially. And then also, aircraft is in high demand. That's driven asset values high as well overall. And leasing has increased as a result in terms of the total markets. So these new players and new entrants have flooded the market in the past 5 years. They do pose risks overall, and I think we have several sort of risk parameters that we assess, about 6 to 8 of them overall, to make us comfortable rating these new lessor platforms. There's been approximately 40 or so deals issued since 2012, including both operating lease aircraft deals and engine lease deals. We've participated in around 13 of them. And I'd say the key theme that we get comfortable across all of those 13 platforms is effectively well-established, good management teams that have been around for a number of years. I'm talking 5, 10 plus years. That's really the key theme for us across the lessors we rate. And going forward, I think that's the credit standard we're going to hold. These teams have got history, they've got good data, solid management teams, good strategies, good growth, and I think we're going to hold the standard there going forward.
Excellent. Thank you, Hylton, for joining me and sharing your perspective.
Thank you.
Next up in our series will be virtual meetings with our global colleagues, so watch this space for new content. If you have any questions related to any of the topics that we discussed, please send an email to the address on the screen. Thank you all for watching.